Greetings, Professor Lee, and to my team members. After covering marketing analysis in part 3, for part 4, our job is to answer a very simple but high stakes question for the CEO. Is Research Frontiers financially healthy enough to justify a purchase? And if so, what is a rational price? Before we take this question, we want to briefly talk about changes regarding our competitors. We initially considered View Incorporated because it is a close direct competitor for Research Frontiers in the smart glass space. And from a strategic standpoint, it aligns well with the technology and end market discussion. However, because View has gone through bankruptcy and no longer provides the level of reliable, comparable financial transparency required for a rigorous analysis, we replaced it with Apogee Enterprises Incorporated. Apogee is a publicly traded North American company with accessible financial data and strong presence in the architectural glass market, which is one of the key end-use segments for Research Frontiers technology. Although Apogee is larger and more operationally established than View, that actually strengthens its usefulness in our analysis because it provides a clearer benchmark for market scale, financial stability, and execution capability. In other words, while View may be closer from a pure smart glass technology perspective, Apogee allows us to evaluate how solutions like Research Frontiers would compete and scale in a real-world architectural glass market with stronger financial comparability and greater analytical credibility. Now, coming back to our high-stakes question, we want to address this question through 4 steps. First, we will walk through 5 years of ratio analysis for Research Frontiers across profitability, liquidity, leverage, efficiency, and cash flow. Second, we will benchmark those ratios against Gentex and Apogee because a ratio means very little without context. Third, we will interpret what those numbers say about sustainability, solvency, and competitive viability. Finally, we will value the company using 2 methods and give a recommended purchase price range. Our overall conclusion is that Research Frontiers is financially weak as a standalone business, but still potentially valuable as a strategic asset if PMF pays for optionality carefully and does not pay for success that has not happened yet. So, we want to address the ratio framework and what we have measured. And before we get into the numbers, Lakshdeep, walk us through the ratio structure. What exactly are we measuring and why?
Yeah, sure. We grouped the analysis into 5 buckets. In profitability, we looked at gross margin, operating margin, net margin, return on assets, and return on equity. In liquidity, we focused on current ratio and quick ratio. And in leverage, we used debt to equity and net debt to equity. And in efficiency, we used asset turnover, and we deliberately did not emphasize inventory turnover for Research Frontiers because it is a licensing company, not a manufacturing company. Finally, in cash flow quality, we focused on operating cash flow and free cash flow trends. And that give us more than the minimum 10 ratios, but more importantly, it let us answer the right question, not just whether the Research Frontiers is losing money, but whether the business model is getting stronger, weaker, or simply surviving. And now let's start with the profitability, because this is where Research Frontiers is clearly weakest. In 2025, fee income was about $1.12 million. Total expense were about 3.25 million, and the net loss was about 2.05 million. The 5-year ratio history tells the same story. Return on equity stayed negative every year from 2021 to 2025, and it worsened sharply to about negative 115.6% in 2025. Return on assets was also negative throughout and deteriorated to about negative 67.8% in 2025. From a market multiple perspective, the company price to sale ratio remained extremely elevated, around 39.3 times at the end of year 2025. Not because the business is highly profitable, but because the revenue base is extremely small and the stock reflects speculative technology values rather than earning power. In plain English, the company is not generating economic returns yet. It is still consuming capital while investors are valuing future optionality.
Thanks, interesting. So the headline is not just negative earnings, it is that the return profile is deeply negative even after several years of development.
Exactly. And that matters because it tells us this is not temporary one quarter weakness. The business has not yet crossed the threshold from technology promise to financially self-sufficiency. The only encouraging note is that revenue did not recover roughly from $500,000 in 2022 to about $1.34 million in 2024 before slipping back to $1.12 million in 2025. That tells us the royalty stream is real but still too volatile and too small to support the cost base.
Thank you, Bakshi. I want to talk about Research Frontiers' liquidity and leverage. Divyansh, if profitability is weak, the next question is survival. Can the company actually fund itself?
That is where the picture becomes more mixed. On paper, Research Frontiers still shows a current ratio of about 3.84 in 2025 and a quick ratio of about 3.60. Those are not distress numbers in traditional sense, but the important point is trend, not just level. In 2021, the current ratio was above 13 times. In 2022, it was above 16 times. In 2023, it was around 12.9 times. In 2024, it dropped to about 10.2 times. And then in 2025, it fell sharply to 3.84. So yes, liquidity still exists, but the margin of safety has clearly narrowed. Debt to equity also increased from 0.12 in 2021 and 0.06 in 2022 to 1.09 in 2025. That is major shift for a company that historically carried very little financial leverage. The 2025 Form 10K makes the deterioration very concrete. On December 31st, 2025, the company had only about $0.7 million of cash and cash equivalents, around $0.9 million of working capital, and total shareholders' equity of about $0.93 million. That is meaningful decline from the prior year, and when cash was about $2.0 million, working capital was $2.5 million, and total equity was $2.6 million. So the company was not insolvent, but it was clearly operating with a much thinner cushion that it had 1 year earlier.
That sounds like a company like that can survive but not very comfortably.
That's exactly right. And there is one more important post-year end development. In Feb 2026, Research Frontier raised about $1.1 million through a private placement of common stock and margin. That does not fix the business model. It does improve short-term liquidity and buys management more time. So our interpretation is that liquidity is still adequate for now, but increasingly dependent on capital raises rather than internally generated cash.
Okay, understood, noted. Thank you, Divyansh. I want to touch Research Frontiers' efficiency and cash flow quality. I want to, Sharma, what do the efficiency and cash flow numbers tell us? And is there any operational improvement underneath all of this?
Yeah, there's a little bit of improvement, but not enough to change the health assessment. Asset turnover improved from about 0.24 in 2021 to 0.36 in 2025, with a low point of 0.11 in 2022. For a licensing company, this is one of the few mildly encouraging indicators because it suggests the company is extracting somewhat more revenue from its asset base than it did during the low revenue years. But the cash flow picture remains weak. Research Frontiers generated negative operational cash flow and negative free cash flow in years and after years. Macro trend shows annual free cash flow of roughly negative 1.81 million in 2021 and negative 2.18 million in 2022 and again negative 2.30 million in 2023 and following negative 0.79 million in 2024. The 2025 Form 10K then shows cash used in the operations of about 1.33 million during 2025. So, although the burn improved in 2024, the business still has not reached a cash flow break even. Another point for the CEOs should care about is concentration risk. Research Frontiers disclosed that in 2025, 5 lessons accounted for 21%, 20%, 20%, and 19% and 13% of free income. That means that the company is not only small but also dependent on a handful of commercial relationships. If one major license underperforms, delays in production, or changes suppliers, the effect on reported revenue is immediate. So the financial problem is not just that the revenue is low, it is that revenue is narrow, it's volatile, and it's somewhere dependent on the partnerships.
Thanks, Sharma. I want to touch about next on benchmarking against Gentex. Now let's benchmark. Lakshdeep, when we compare Research Frontiers to Gentex, what stands out first?
Gentex is basically the opposite profile. It is profitable, liquid, lightly levered, and cash generative. In 2025, ratio page shows a current ratio of 2.91, quick ratio of 1.34, and debt to equity essentially 0. And return on equity around 15.5% and return on asset around 13.9 and asset turnover around 0.89. On margins, the business is also far stronger. Gross margin was about 34.2%, operating margin was about 19.2%, and profit margin was about 15.2%. And unlike Research Frontiers, Gentex convert earning into cash. We looked up Research Frontiers company profile on stock analysis, shows operating cash flow around $587 million and free cash flow around $458 million on trailing basis. While macro trend shows annual free cash flow of around $296 million in 2021, $192 million in 2022, $354 million in 2023, and $357 million in 2024. So when we use Gentex as a benchmark, the gap is not subtle, it's enormous.
So Gentex is not just the competitor, it is the standard for what scaled financial discipline looks like in this space.
Yes, exactly. Gentex shows what happened when advanced light control products are supported by manufacturing scale, direct customer relationship, and operational leverage. Research Frontiers have many interesting intellectual property, but financially it is nowhere close to Gentex level of durability or consistency.
Okay. Thank you, Lakshdeep. I want to next take this benchmarking against Apogee. So Sharma, it is a different business, but still an important benchmark regarding Apogee. What do you think?
Yeah, Apogee is useful because it shows what real financial execution looks like in an architectural class market. Its current ratios has stayed around the mid ones and improved to about 1.90 currently. Debt to equity is much higher than Gentex, around 0.69 in physical 2025 and about 0.58 currently. So it is more leveraged than Gentex, but still manageable for a mature industrial business. Return on equity was about 17.7% in 2025, after peaking about 22% in 2024. And return on assets was about 8.7% in 2025. Asset turnovers has stayed above 1.1 and was about 1.32 in 2025. On valuation and margin perspective, these metrics, Apogee is nowhere near as profitable as Gentex, but it is still a real operating business. EV to sales was about 0.97 in 2025. Current EV to sales is about 0.69, and current EV to EBITDA is about 5.97. Free cash flow was positive each year from 2021 to 2025, ranging between about 65 millions to 161 million dollars. The reason this matters is very simple. Even the weaker of the two benchmarks, Apogee still looks dramatically healthier than research frontiers on every core measure. Apogee is not a perfect peer technologically, but financially it gives us a real check. It tells us what a viable public company in adjacent class and building materials market looks like. Positive returns, positive cash flow, moderate leverage, and consistent scale. Research frontiers does not yet meet that standard.
Thanks, Sharma. Next, I want to talk about companies' trend and health assessment. I want to circle back to Divyansh. If you had to summarize the trend and health assessment in very plain language for Professor Lee, what would you say?
I would say a research frontier is liquid enough to survive in the short term, but not financially healthy enough to be called self-sustaining. Profitability is still deeply negative, liquidity is shrinking, leverage has risen, cash burn persists, and competitive viability depends more on commercialization optionality than on present operating performance. That said, I would not call it financially broken in the same way a distressed manufacturer might be broken. It has low absolute cash needs, no huge factory footprint, and royalty-based model that can scale if the right vehicle and retrofit programs actually convert into volume. The problem is that today's income statement does not prove that is scale yet. There are also two contradictory signals in the numbers. The negative signal is obvious. The company lost over $2 million in 2025 on little over $1.1 million of fee income. The positive signal is more strategic. Management disclosed that the Cadillac Classic program entered serial production during 2025. Ferrari production was transitioned successfully after a European licensee bankruptcy, and the company launched a prefabricated architectural retrofit system in late 2025. So financially, the business is weak, but strategically, there are proof points that a platform may be moving from concept stage volatility toward early commercial scaling. For PMF, that means the purchase case is not based on current financial strength. It is based on whether we believe those commercialization signals are real enough to justify a controlled bet.
Noted, Divyansh. Thank you. Next, I want to talk about valuation approach. I want to briefly talk about it. What methods did we use and why we did those? We deliberately avoided using a standard EBITDA multiple as the primary method because research frontier is loss making and a negative EBITDA multiple quickly becomes meaningless. Instead, we used two methods that better fit the company's stage. The first is a market anchored valuation based on current enterprise value and a modest control premium. The second is a conservative scenario-based discounted cash flow built around revenue scaling from existing programs and the new retrofit opportunity. Together, those two methods let us triangulate a range rather than pretend there is a single perfect number. So, I want to move to the first method, the market-based valuation. I want to move to Lakshdeep. Could you please elaborate on that?
Yes, let's start with the market-based approach. Research Frontiers market cap was about $35 million and enterprise values was about $35.5 million in mid-March 2026. On trailing basis, the stock was trading at roughly 31 times sales and over 36 times book value. Those are obviously not normal industrial multiplies. They tell us the market is pricing optionally, not financially performance. So for acquisition, I would not simply pay the quoted market price and add a huge speculative premium. Rational acquirer would start with current enterprise value as the floor and then consider only a modest control premium. Because the business still needs capital, execution and commercialization support after closing. Applying a roughly 10 to 25% premium, giving an indicative value of about 39 million to 44 million dollars.
Okay, thanks for that number. So even though the stock market is already capitalizing hope, your view is that PMF should still stay disciplined.
Yes, exactly. If we go materially above that range without stronger evidence of commercial conversion, then we are paying today for revenue that still belongs to tomorrow.
Noted. Thanks, Lakshdeep. The second method, the scenario that we thought is discounted cash flow, and I want to ask Sharma about it. Could you walk us through the DCF logic?
Yeah, our discounted cash flow is intentionally conservative. We started from 2025 fee income of about 1.12 million. Then we built a 5-year scenario where revenue grows meaningfully but not heroically, based on 3 assumptions. First, continued contribution from premium automotive programs. Second, some recovery and expansion in royalties after the Ferrari supply transitions. And third, gradual commercialization of the architectural retrofit system. In the base case, we assume revenue scales into the roughly 3 million to 4 million range over 5 years. Operational losses narrows as royalty revenue scales faster than the fixed overheads. And the company reaches modest positive EBITDA but not a mature margin profile. We use a high discounted rate because this is a tiny, risky, partner-dependent company, and a low terminal growth rate because long-term success is still uncertain. Under the structure, the present value comes out below the public market implied values, roughly in the high 20s to low 30s million range. The reason the DCF comes in lower than the market anchored method is important. It tells us the current share price already embeds strategic upside and option value that a strict fundamental model does not fully justify yet. So if PMF wants to buy the company, it should recognize that part of the price for possibility, not proven cash flow. This is acceptable in a scale-up acquisition, but only up to a point.
Thank you, Sharma. Noted. Next, I want to touch sensitivity and downside. I want to ask Divyansh, what breaks the valuation on the downside?
There are 3 things. First, if revenue stays near the current $1 million to $1.5 million range for another 2 to 3 years, the DCF falls sharply because the fixed cost base remains too high relative to royalties. Second, if 1 or 2 large licenses disappoint, the concentration issue immediately hits revenue and cash flow. Third, if PMF overpays on the basis of hype and then still has to inject additional commercialization capital, the effective purchase multiple becomes very hard to defend. On the downside, I think intrinsic value can slip into the low 20s or even high teens millions. On the upside, if the retrofit product gains traction and automotive royalties scale faster than expected, you can justify value in the mid 40s. But beyond that, you are paying for a best case story, not a disciplined acquisition.
Thank you, Divyansh, and I want to thank all 3 of you for doing all of this research and helping us give a recommended purchase price. And so let's land it. What is the price recommendation we would actually put in front of Professor Lee? Well, our recommended price range is about 38 million to 45 million equity value, with the preference to stay in the low 40s only if diligence confirms near-term revenue conversion from the existing automotive and retrofit pipeline. That range does 3 things. It sits modestly above current market value, so it is credible for a controlled transaction. it respects the fact that Research Frontiers is still loss making and cash burning, and it preserves room for PMF to invest after closing, which it will almost certainly need to do in partner management, commercialization support, and risk control. We would be uncomfortable going above roughly 50 million, because at that point the buyer is no longer paying for a strategic option, it is paying as if the strategy has already been proven. So let me close with answering this in one sentence. Financially, Research Frontiers is the weakest company in the three company set by a very wide margin. Gentex is the gold standard, Apogee is a healthy operating benchmark, and Research Frontier is still a speculative licensing platform with deteriorated liquidity, negative returns, and persistent cash burn. But it is not worthless, because the company still has a public image, a royalty model, active automotive programs, a new retrofit product, and enough liquidity to survive if commercialization improves. So our recommendation is not do not buy. Our recommendation is buy only if PMF stays disciplined, values the company as an early scale-up asset rather than mature operating business, and keeps the purchase price in a controlled range of roughly 38 to 45 million. That's our presentation.
Thank you.
Thank you so much.